Hey, good morning, everyone. Marty Mazzora here. It's Friday, the 18th of October, 2024, coming at you for the first time, I think, in 3 weeks with a video. Had some technical difficulties with the old program, updated to some new software, and it just had a glitch that we just could not get fixed, even with the vendor's assistance, although remotely and in not the most responsive fashion. So more than you need to know, but we've got some new software now. And we're back up and running with the videos. So even though it's been 3 weeks, I think I can be very succinct and not take too much of your time. We're going to skip the usual that I do with the inputs to our index. It stayed the same at a -4. So what I wanted to do today, though, is talk about inflation a little bit and kind of the dynamic since the Fed cut interest rates by 50 basis points recently. And I'm going to get to some of the inputs to our financial conditions index. And then we'll move to a technical look at stocks, the dollar, and at gold. So just kind of jumping right in front of you is our CPI swap spreads for 2, 5, and 10 year. And these are considered inflation expectation gauges, really inflation compensation, but the market kind of talks about that with regard to expectations, essentially discounting market sentiment around inflation going forward. So being that these are CPI swaps, you can see that as they go up, that suggests that inflation pressures are expected to go up as well. So my point here, though, is that since the Fed meeting, when they were cutting interest rates, and there was a lot of hope and anticipation, I know from, say, the mortgage lending sector that, hey, mortgage rates are going to come down. Well, they actually went in the opposite direction. Reason being is because almost coincident with the Fed cut or leading up to it and certainly thereafter, the data have gotten better. I've mentioned that our own index at a -4 is pretty close to the neutral zone. Still says that odds favor recession, say, it doesn't really time it, but I always say on a 6 to 12 month outlook. And that's still our base case, and I think there's still a lot of under-the-surface data that we should be concerned about. Some of that will probably come up in this monologue. But suffice to say that things have gotten better. The Fed, pretty aggressive with that 50 basis point cut. Fed funds futures have been discounting several cuts between now and, say, mid-year next year. That's come off the boil, definitely, in terms of expectations. So based on all the data available today, the market is now suggesting, hey, the Fed may not be cutting like we had thought they were going to. Now, the stock market's done fine despite that. And I want to say despite that because, of course, the market was looking forward to lower interest rates and hopefully a soft landing. But so I think it's kind of a combination now. You have still an accommodative Fed. They're long ways from hiking rates, probably another cut or 3 coming even based on current data over time, not all at once. But the economy is looking a little better, right? At least on the surface. Now, our base case actually is that despite what we're seeing in, like, for example, CPI swaps, and I think what we're actually going to see in the coming inflation reports, that it was hotter than the September print. Before this all shakes out, I actually still anticipate that it will all reverse. The economy will show further weakness. Inflation expectations will come back down, and the Fed will be back into cutting mode. That's in that slowing economy / recession scenario. If that's not there, the equity market has a problem as well, as does the bond market, because if we don't get that, then we don't get inflation coming back down, and you don't get the lower interest rates, and you get even higher valuations on stocks, which are very historically high right here. So anyway, let's keep going. So there was your CPI swaps. Here's the Baltic Dry Index. Tracks the cost of shipping goods across the world's oceans. You can see that's coming down a little bit, quite the drop here the last couple of weeks or so. I also like to drill into container shipment costs. So the WCI container freight benchmark rate, you can see that that's dropped considerably. So this is what, politicians and or policymakers will herald as, just inflation coming down. Well, $3,200 relative to, way less than $2,000 4 years ago, historically speaking, is still pretty high. But yes, on a rate of inflation basis, that definitely does, help, no doubt about it. Being more specific here, Shanghai to LA, you can see they're coming down, which is great, but still historically very, very high. Okay, so it's one thing to talk about the rate of inflation, and this really wouldn't be the example for what I'm about to say, but folks, it's really cumulative inflation that is a problem. I would say that bottom 40% of the income distribution among Americans are really struggling mightily, if not desperate right here. And 2% inflation is not going to fix their issue. Their issue is that the cost of living has run faster than their incomes have. Now, many economists will paint you a more bullish picture or a more optimistic picture of that and look at wage increases and so forth. I don't know that that's across the board, and from what I'm seeing in other places, and I'll show you a little bit of that here, dispute that a bit in terms of consumer sentiment and some of the information coming from the banks. Also, as part of that financial conditions assessment that we do each week, one of the things we look at is the Treasury yield curve. This is famous, has been for decades and decades, as being the recession indicator, and that is when the yield curve inverts, which would be when long-end interest rates drop below short-end interest rates. This is the 2-year, 10-year relationship. So this means that below zero, that 10-year interest rates or yields on treasuries went below 2-year. And sometime after that begins, you should expect that there's a recession. Now, it can be months and months on the horizon, right? One thing that we've noticed, and I think other analysts and people who watch this closely have, is that it typically steepens right before recession, or even steepens to the point of uninversion, as it's done right in here, right? These last 3 or 4 recessions. And uninversion means the yield curve goes back to what we'll call normal, where the 10-year is higher. Okay, so why is it that things get more normal right before recession? Well, think of it this way. The yield curve comes down as the 2-year, which is really a reflection of Fed funds rates, starts to rise in anticipation of the Fed raising interest rates, right? And it rises faster than the 10-year. So people are selling the 2-year, which pushes the yield up. They may be selling the 10-year as well. The yield just isn't going up as fast, and therefore ultimately gets to the point where the 2-year rate exceeds the 10-year rate, right? The coming back down typically is the Fed's reversal of that trend. Now we have recessionary fears, and the 2-year reflects rapidly falling Fed funds rates, right? The 10-year is being purchased as well. The yield's coming down in anticipation of recession, but the dramatic decline and the big buys are on the short end, and therefore we get back to that. So that's called a bull steepener, because people are buying bonds. They're just buying the short end, pushing those yields down faster than the long end. And that, folks, is what's been happening right here, right? Is that the 2-year was careening as the Fed cut interest rates by 50 basis points and promised a lot more. Even though people were buying the 10-year and it was coming down as well, the 2-year was coming down faster. So you got that reinversion. Now, since that 50 basis point rate cut, we've had a whole different phenomenon. Suddenly, the 10-year has spiked up because they thought, maybe that's a little too much. Maybe they didn't need to do that much. The data's getting a little better. Maybe that's going to be inflationary. And while the 2-year is still reflecting, perhaps, still reflecting some rate cuts going forward, the 10-year is starting to reflect perhaps an increase in inflation going forward. So that's the 2-year, 10-year. Now, everybody's focusing on that, all the recessionistas, if you will, and saying, here it is, we're going to have recession. Well, the 3-month 10-year has always been the one the Fed has looked at, right? And yes, now it is definitely steepening, right? But it has not uninverted just yet. We still have the inverted yield curve with the 3-year, 10-year relationship, but now finally it is moving pretty rapidly in the direction that typically says, recession is maybe on the horizon. Every time, by the way, folks, and I've lived through all of these all the way back. I started my career right here, but of course I studied everything prior to that. It's always different this time on the yield curve. Every single time, real smart people are coming up with arguments that it's not going to work this time. And maybe they're right. It was inverted for a very, very long time. So maybe it won't be that indicator, but I do still believe in the economic cycle, and the end of the cycle is, almost by definition ends in recession. The question is it going to happen in the next 6 months or, the next 6 years, I guess. So Wall Street has left the recession camp, and we're in the soft landing camp. The problem with that is that if we are, then interest rates aren't going to do what Fed funds futures expect or what current valuations in stocks anticipate. So stocks in the U.S. in particular, and we won't get into U.S. versus foreign valuations today, but we need to, because the U.S. from a valuation standpoint is probably the least compelling looking equity market in the world right here. Okay, so another one. Now this paints a very sanguine picture. This is the high yield spread and 10-year junk bonds versus the 10-year treasury. And so the tighter the spread means the lesser the premium you're getting for taking all that risk. And there's only a 3% difference. And as you can see historically, that's very low. So it says that investors are very comfortable owning junk debt right here. Now notice how it does tend to pop quickly when things begin to turn. So investors will abandon those junk bonds at the first sign of risk. And you've seen that we've had some signs of risk here, but that's a very comfortable, sanguine view, and it leads to low ratings on many of the financial stress indexes, like, for example, the Chicago Fed Financial Conditions Index, which is way down there in easy territory, if you will. Also, credit default swaps. We watch these very, very closely. This is our chart on the cost of insuring investment-grade corporate debt against default. And you can see that is historically low right here. Same story though, right? Tends to pop very, very quickly as suddenly the economy begins to show weakness and investors start getting scared. Now, with the COVID example and the way the Fed swooped in to the low quality bond market, I think some of this sanguineness is based on this precedent that they've now set, that the Fed is going to work overtime with massive ammunition to keep the credit markets from folding or cracking or hemorrhaging or what have you. We saw them rush quickly to the Silicon Valley Bank scenario here not that long ago. So it is a little different this time in that respect, but these are still indicators of risk in the market's perspective anyway. Speaking of the 2-year, 10-year spread, this is the 2-year Treasury yield. This is the Fed funds rate. This kind of reflects a little bit of what I said earlier. This is the reflection or the anticipation that rates are going to come down when the 2-year rolls over. It's anticipating that rates are going to go up. Here, when it goes up, you see the orange line going up, and then a few months later, Fed funds rates increased. Going down, then the Fed cut rates. Going down, the Fed cuts rates. And you see what that going down tends to coincide with ultimately is recession. Not every time, but pretty wide gap between the Fed funds and the 2 years. So the 2 years it's really reflecting anticipation. I don't really want to say that this is a recession indicator. What it is, it's an indicator that the Fed's going to cut rates. It just so happens that this illustrates that typically when they're doing it because of some serious risk in the economy. I would also note, though, it's not unusual to get a pop higher like we did here, like we did here a little bit, like we did here, like we did virtually every time, right before recession. And that's that interesting phenomenon that the data does tend to come back, and I've shown you that on many of the economic data points that we use right before recession happens. So we'll see how this one plays out. The MOVE Index measures volatility as priced into Treasury security options, the implied volatility. Above 100, you need to look out. So I've shaded areas here recently since 2000 of above 100. Now you see in the 90s during the tech bubble. We need to always think about that too. We had a lot of volatility up here, but nothing really dramatic, although that was a 20% decline here in 1998. But the big 50% decline for the S&P, 80 for the NASDAQ came amid a lot of above 100 volatility in the MOVE index. Same thing here in 2008. Same thing here. We had a 20% dip, 10 and then 20. 8 or 9% dip in there. 40% dip right here almost. 38, let's call it. And then a 30% peak to trough dip in 2022, but we're still elevated. So essentially that illustrates risk that can lead to, disruptions, spikes in yields and so forth that could play havoc with the equity market. The Treasury Liquidity Index as well, when this is up, that means liquidity is strained for U.S. Treasuries. Hasn't been this high very often, but it got really high during the real estate bust. You can see we have data just back to just before there. The 16% hit in this period right in here came amid stress, if you will, in Treasury liquidity. Of course, it happened very quickly around COVID. We've been riding there for quite some time. We have had some volatility, but we're not coming back down in terms of Treasury liquidity for what that's worth. Okay, so let's just, I think I'll go through the market technicals and then we'll finish with gold and then I'll run through some notes with you and we'll call it a day. So folks, we'll just start with the monthly chart. Very slow moving. You like it? Not many false signals. So here we have a rising wedge pattern. Here we have a bearish divergence with pretty strong momentum. But here we are overbought on the RSI on the monthly chart. And all we got to do is go back and look at when we've been overbought before, and we tend to get some, pretty good downside volatility following those periods. But, the combination of the pattern, the momentum or the lack thereof, those divergences, says that we need to, be cognizant of the downside risk here. I'll just jump to the 1-year daily. So, again, pardon all my levels in here, but it looks good from a 50-day moving average is sloping higher. It's well above the 200-day moving average. Still that same kind of pattern with these divergences. It says that we'll get to the point where we see something decent to the downside. Of course we will. The question is, is it going to happen sooner than later? I've expressed many times here on the blog that I'm not bearish between now and the end of the year, maybe early into next year, election notwithstanding. The NASDAQ 100 index ETF that we track got just a nascent sell signal there, actually. This one's not getting back to new all-time highs. The bulls would say, it's a broadening out, makes a lot of sense, it's bullish. We'll see. It's not a great-looking chart, I'll tell you that. Remember back here in the dollar, we looked at this literally right here, and I said, the world seems to be very bearish the dollar because the Fed's going to be cutting interest rates, and that was a plausible narrative at the time. But I said, technically it looks like the dollar is going to pop. And man, oh man, has it popped, very interestingly. So this is as the data got better, and suddenly the U.S., compared to the rest of the world, looks like that we may not be able to be as accommodative as, say, the European Central Bank, as they announced yesterday, and so on. So that's put a real bid under the dollar. We're having a down day today, and but that typically is a headwind for stocks. Stocks have been going up anyway as the market's been embracing this no recession theme. But this is ultimately probably a headwind for stocks, and the dollar did get overbought, which is fairly rare as of yesterday. And then gold's interesting. I wrote about gold this week in the written blog. Here we are at all-time highs. Really negative look to me, technically speaking, although that's a buy signal right there, but I like these divergences I respect more right here. So gold has gotten a little bit ahead of itself. In fact, let me just pull over what I wrote in the earlier this week or midweek. So what gives with gold? Gold resting at all-time highs amid rising long-term rates, and not to mention a strong dollar, is not intuitive. So what gives? 3 possibilities. Gold is reflecting underlying economic weakness and thus the prospects for recession and or exceptionally easy monetary policy going forward. So gold is absolutely bucking the trend of what the stock market is saying, or the trend of the stock market, if this is really what's going on. Or gold is the shiny thing that central banks like. Indeed, it is, as they try to diversify their reserves away from the U.S. dollar. That may be it right here, or most of it, right? Longer term, it could be that gold is forecasting a stretch of negative real interest rates in the years to come. So we've got this massive budget deficit that nobody on either side of the aisle is talking about. You've got to fund that deficit, so you got to issue bonds, right? Also, we've got trillions of debt. That COVID debt was all short-term, low-interest debt as far as the eye can see, not to mention the rest of it. And are we going to be reinvesting in a good economy with higher interest rates? Look what that's going to do just to the interest payments, which are now bigger than like the entire U.S. defense budget, right, annually. So it virtually demands that the Fed be the buyer. And I said here, a first and last resort to be dramatic, as they'll need to quell otherwise rising yields amid U.S. debt issuance and what are now notably structural inflation forces far into the future. So it's called yield curve control. We did that, or the Fed did that, right after World War II. Basically, they just bought all the issuance necessary to keep yields at 2.5% from like 1945 to 1952. And therefore, we grew, through inflation, we grew GDP out of like 116% debt to GDP ratio, well below it by 1952. That's probably the most likely solution. Now, that means we got to run for quite some time with negative real interest rates, meaning the actual interest rate less inflation being negative. Inflation runs hotter, and that is quite the setup for gold. So is the market looking that far ahead? I don't think so, actually, but I think that's worth noting. And it speaks to why I think we're going to have gold for quite some time going forward in our core portfolio. So 1 and or 2 are very plausible, all things considered. The one thing, though, is that gold is just getting out there way over its skis right here technically. So we're not even really hedging it right now. We'll hedge it from time to time. We did, I think, last year and the year before quite successfully. There's just something different going on here, and we've just broken out of all-time highs. That could actually gain momentum. You get 2 days above a breakout, and suddenly it's legit and it's for real. My base case is that we're probably going to see it come back down, below those levels for a while, right? Particularly if the data doesn't slow. And I do think the inflation data is actually going to get a little hotter, not cooler, before it gets cooler later into next year, if indeed the economy is going to slow up more. Okay, so in closing, let's see what I have for you just from our internal notes. As you've probably noticed, we lean heavily on Peter Bookvar. We pay for his research. He's just such an awesome source, very objective, good work. It really gets into the weeds for us, and a lot of the things we get in the weeds as well. But it's nice to have the luxury of just looking at someone who we trust and respect and get their comments on some of these things. So the New York Fed's Consumer Expectations Survey came out on the 16th. And so with regard to inflation expectations, 1 year out remained at 3%, which is high relative to what the Fed wants. It rose to 2.7 from 2.5 on a 3-year view and so forth. So people are still fearing that inflation is going to be higher going forward. Labor market questions got a little better, but were not really changed in terms of income. On the credit quality side, the average perceived probability of missing a minimum debt payment over the next 3 months increased for the 4th month in a row to 14.2%, the highest reading since April of 2020 when we were fearing for our lives. So that's not a good-looking chart. It doesn't speak well of the health of at least a good chunk of the consumers out there. Oh, we've got bank earnings. Jane Fraser with Citigroup does a really good job of giving straight-up commentary. She talks about manufacturing weakness in Europe and so forth, talks about China. Bullish on emerging markets. We are too, on a longer time frame. Talked about gold. Highest Chapter 11 bankruptcy filings in more than a decade. Again, while the data is improving under the surface, we're seeing stuff that doesn't make you feel all that warm and fuzzy. Jamie Dimon, JP Morgan CEO, says that cash is a very valuable asset sometimes in a turbulent world. You see Warren Buffett, his friend, stockpiling cash right now. People should be a little more thoughtful about how we're trying to navigate this world and grow for the long term of our company. So yeah, we agree. We've got probably the biggest chunk in short-term treasuries that we have in many, many years. We're not as bearish as we might have been, say, a few months ago. So we've done some tweaking to pick up a little more upside potential. We'll do fine in a no recession scenario, but we need to be hedged so that we'll do fine in a tough go-forward scenario for the market. And then one other thing I'm reminded of, which goes back to the blog post point, John Authors talks about the earnings yield for stocks falling below the 10-year treasury yield. He says that could be a tipping point and it could be time to get the heck out of stocks. I think there's lots to worry about in the market, but I did point out here that, all this time it was there and, stocks did well. And then what I say here is, nevertheless, this just adds to an abundance of evidence that at a minimum, conditions do not remotely possess the characteristics of the beginning of a sustainable long-term up move in equities. Jeremy Grantham, he's often bearish, I must say, but he said, we have great employment numbers, we have wonderful profit margins, all the things you would not want to start a bull market from. These are the things bear markets start from. That's true. Great bull markets start from coming out of recession and, high employment and not so wonderful profit margins. But I did say that, not to say that full employment and wonderful margins are anything to complain about, but when I consider present valuations, the fact that we are late cycle, in our humble view, very late cycle, and that at least the soft data say the labor market is showing signs of weakness, well, we are indeed flirting with a dangerously overextended market, call it overtime innings. Now, that said, it would not surprise me in the least to see the market continue to melt higher for the next few months. Seasonality is in its favor. Earnings season, when they've lowered the expectations so low, the odds of beating earnings, and we're seeing some of that already, are high. So yeah, I think you should look for stocks, particularly post-election, to do pretty well. I referenced John Hussman earlier, so then I said, speaking of John Hussman, he does the best job, I think, on looking at valuations and extrapolating long-term odds for returns going forward. And based on his unique and proprietary valuation metrics, and then he's even referencing Robert Shiller's, and you've seen me talk about that in our equity market conditions analysis. The available data since the 80s and the current forward price-to-earnings ratio, yada, yada, 10-year expectations for the S&P 500 should be somewhere between minus 2% and 3% annually. And he's not the only one who's done that work, by the way, and come up with a similar projection. And then he, in his own September update, he did say that, what will matter is full cycle discipline, flexibility, yada, yada. Unfortunately, those are the last things investors have on their minds. Instead, they become convinced that it is enough just to buy and hold stocks forever. And then my point here is that, sadly, that's the thinking that immediately precedes market tops. It has to. But of course, that says little, if anything, about precisely when those tops will occur. It's just that amid historically high valuations and sketchy internals, the risk that it could be sooner than later is too high to ignore. So folks, let me end with this. All that in a nutshell. I know I'm still sounding a bearish tune, if you will, but also know that I have acknowledged, frankly, that our own assessment of macro conditions has improved, that we're relatively bullish on a few-month outlook going forward. The election could have implications, one side versus the other. I've said to a few people, I think maybe we'll get into that in the videos. I keep electing not to. It's hard to really believe that certain campaign promises that could impact certain things would actually happen, in the real world once the party is elected. But we'll see, and we'll probably have to get more into those weeds over the next week or two. But suffice to say that there are pockets of strength. We are not complaining. We're feeling good about doing well in areas other than just the stock market. Folks, that's what a diversified portfolio is all about. That's why you'll look at your portfolio some days and stocks are up and you're not up that much, if at all. Some days the market's flat or down and you're actually up a bit. The world of investing and doing it right is not about stocks. It's not about bonds. It's not about gold. It's not about any one of those things. It's about a global macro view of all asset classes, assessing risk-reward setups and opportunities, and then allocating accordingly within that context, if you will. I will leave it there, folks. Thank you so much, as always, for watching and listening. Have a wonderful weekend. Take care. Bye-bye.